Welcome to Iron Financial. I am your lead analyst, and my mission today, just like every day, is to help you forge a much stronger portfolio. We're going to cut right through the noise, ignore the market weakness, and look past the glossy headline metrics. The goal? To build you an absolutely indestructible financial foundation. Today, we are putting on our hard hats, we are drilling straight into the structural integrity of Johnson & Johnson's freshly released Q2 2026 earnings report.
And I'm your market skeptic. I'm sitting right here to represent your hard-earned capital. Because let's be real, when a massive conglomerate rolls out its quarterly numbers, management always wants to show you the newly painted exterior. My job is to push back on that hype. I want to know if this growth is real or if it's just a house of cards waiting to collapse. I'm going to demand absolute clarity on the heavy industrial realities our analyst throws at us. We are doing a full, no-holds-barred structural inspection of JNJ today. Are there cracks in the foundation, or is this iron totally solid? Let's get to work.
Market skeptic. So here is the billion-dollar question we have to answer today. Johnson & Johnson is a 140-year-old titan. It has a massive, sprawling global footprint. But in this current macroeconomic environment, is that sheer size truly an ironclad foundation for your retail capital? Or is this massive pharmaceutical and medtech structure slowly turning into a giant value trap, just weighed down by rust and legacy costs?
Well, that is exactly what we're going to find out by stress testing these blueprints. Now, before we start drilling into the raw data, if you want to keep forging a stronger portfolio and survive the market's heavy lifting, hit that subscribe button to Iron Financial. We do not do fluff here. We do structural reality. So let's take a look at what J&J's executive team actually wants you to believe right out of the gate.
Right, let's start with the glossy PR spin coming straight down from the top floor. Joaquin Duato, their chairman and CEO, is out here saying, and I am quoting this directly, "We are on track to meet our 2026 target of more than $100 billion in annual revenue for the first time in our company's 140-year history." I mean, they're popping champagne over a record-breaking $25.3 billion quarter. It sounds fantastic, right? But I just have to ask you, is this real, load-bearing structural growth, or is management just slapping a fresh coat of paint on a rusting frame to keep Wall Street happy?
Look, it is a great headline metric. But at Iron Financial, we don't trade on quotes. We trade on the hard numbers. That $25.3 billion in worldwide sales represents a reported growth rate of 6.6%. And hey, on paper, that looks like solid steel. But when you step onto the factory floor and actually strip away the external environmental factors, the internal metrics tell a slightly different story. Let's peel this back and look at the true operational growth.
Here is where the top-line spin hits structural reality. Yes, reported growth is 6.6%, but if you look at their operational growth, which completely strips out the impact of translational currency, that number actually drops down a full percentage point to 5.6%. Adjusted operational growth sits at roughly 5.7%.
Hold up. You need to explain to the viewers where that massive difference actually went. A full 100 basis points of growth just vanishing into thin air? That is not a rounding error, man. That is structural wear and tear. Translational currency shouldn't just be brushed off as some accounting footnote. Think about it. If you are a US-based investor, this means the strength of the dollar overseas is acting like acid rain on their international revenues. Sure, they are generating sales out there, but when they bring that cash back to the home balance sheet, it is simply worth less. That 6.6% number is actively masking the reality that the core operational engine is really only humming at 5.6%.
And honestly, it gets even worse when you look at the bottom line. This right here is what I call the earnings anomaly, and it is a glaring crack in the armor. Just look at these numbers. Reported GAAP net earnings actually fell. They dropped by 0.1% to $5.534 billion. GAAP earnings per share dropped 0.9% down to $2.27. So the actual raw, unadjusted profitability of the entire company shrank, yet management turns around and points to their non-GAAP adjusted EPS, which somehow magically spiked up 4.7% to $2.90. Seriously, how do you construct a narrative of record-breaking growth when your GAAP earnings are literally sinking into the concrete?
That is the exact stress test we need to run right now. The gap between GAAP and non-GAAP is exactly where the heavy industrial realities of corporate finance live. When you see GAAP EPS drop while adjusted EPS spikes, it means management is taking massive structural write-offs, heavy amortizations and one-time charges, and basically asking investors to just ignore them. We aren't going to do that. Let's pull up the actual visual receipts from the earnings report to see exactly where the cash is bleeding out of this foundation.
Look at the raw blueprint on the condensed consolidated statement of earnings. You can clearly see sales to customers hitting that $25.31 billion mark. Excellent. But look immediately beneath that. The cost of products sold is $8.051 billion. That's up 5.5% from last year. Selling, marketing, and administrative expenses are sitting at $6.432 billion, jumping 9.2%. The cost of just keeping this massive 140-year-old machine running is accelerating way faster than the operational sales growth itself. The gross profit margin is holding up, sure, but the operational friction is incredibly heavy.
Exactly. You look at the cold hard math, and the wear and tear is just so obvious. Earnings before the provision for taxes on income only grew a measly 3.9%, but the actual provision for taxes spiked 27.1% to over $1.2 billion. That right there is why GAAP net earnings are slightly negative. But I want to drill even deeper into those adjustments you mentioned earlier, because management is using a massive industrial-grade welding torch to bridge the gap between that $2.27 GAAP EPS and the $2.90 adjusted EPS.
We have got to talk about the two heaviest adjustments they are making here. Intangible asset amortization is costing them a staggering $1.245 billion. That's this quarter alone. And on top of that, they took another $276 million hit in restructuring charges. My question to you, analyst, is this. Are these just standard, everyday maintenance costs for a company this size, or is management aggressively sweeping real, permanent wear and tear under the rug just to make that non-GAAP EPS look pretty for the Wall Street analyst?
Well, honestly, it's a bit of both, but you absolutely cannot ignore the sheer weight of it. That $1.245 billion in amortization? That is heavy balance sheet welding. It's the rigid accounting cost of past acquisitions degrading over time. But that $276 million in restructuring, that is a very real, tangible structural overhaul cost. It's real money. And as we'll see a bit later on, it's just the tip of the spear for a much larger, very expensive project. But to understand if the company can actually carry these costs, we have to inspect the core operations.
Section 1. The Twin Pillars. Inspecting the segment foundations.
We are breaking down the twin pillars of Johnson & Johnson today, the innovative medicine segment and the med tech segment. These are the twin silos that literally holds up that entire $100 billion annual revenue target. If just one of these pillars shows signs of stress, the whole structure is at risk. Innovative medicine is the absolute bedrock of this company. It pulled in an astounding $16.384 billion this quarter, driving a highly impressive 7.8% reported growth or 6.8% operational. The heavy lifters propping up this revenue structure are doing massive work. In their oncology division, you have Darzalex, Carvykti, and Tecvayli acting like reinforced steel beams, driving immense volume. Over in neuroscience, Spravato and Caplyta are also providing absolutely critical load-bearing support.
All right, I'll give credit where it's due. Those oncology drugs are absolute powerhouses right now. I look closely at the specific materials making up these pillars, and I have to admit, that pipeline is strong. But you're only showing us the shiny new scaffolding. What happens when your oldest, most reliable support column starts to crumble? Because hidden inside this 7.8% growth rate is one of the most severe structural headwinds in the entire pharmaceutical industry right now. You can't ignore this.
Market Skeptic. 760 basis points. That is the exact negative impact dragging down the innovative medicine operational growth right now. Why? Because of the Stelara patent cliff. Stelara is facing a massive, unrelenting wave of biosimilar competition. It is eroding growth by a staggering 7.6%. That is a massive, deep crack in the armor of the innovative medicine pillar. I mean, how long can Darzalex and Carvykti really continue to carry the weight while a massive legacy drug like Stelara continues to completely collapse it on itself?
You're right to call it out. It is the defining structural risk of their pharma portfolio. But look at it this way. The fact that they still managed 6.8% operational growth despite a 760 basis point headwind from Stelara is actually a massive testament to the sheer strength of their newer oncology assets. The foundation is holding, but yes, the load distribution is shifting radically. Let's pivot for a second and look at the second pillar, MedTech, which has a very different set of stress metrics.
The medtech segment is the smaller, slower-growing pillar of the two. It brought in $8.926 billion, with 4.5% reported growth. But when you drill down to operational growth, it sits at 3.6%. And here is the specific structural flaw we really need to analyze. The U.S. operational growth is maintaining a decent 3.9% pace, but international operational growth is lagging noticeably at 3.2%. When your international scaffolding is building out slower than your domestic base, you have an unbalanced structure. It's just a fact.
And when you look closely at what actually drove the growth in medtech, you realize management is basically just buying prefabricated parts to weld onto the balance sheet. They cited wound closure products, electrophysiology, and specifically the cardiovascular segment. But let's be totally honest about where that cardiovascular momentum is actually coming from.
Management explicitly called out the Shockwave acquisition and the new C2 Aero coronary IVL catheter launch. My major concern here is that the MedTech Foundation is becoming way too reliant on purchased growth. If you have to go out and acquire a massive company like Shockwave just to maintain a mid-single-digit 4.5% reported growth rate, how organic is your foundation really? Are they just masking internal R&D weakness with massive, highly expensive M&A wielding jobs?
Look, inorganic growth is still growth, but you are absolutely right to question the long-term cost of that capital. When you buy growth, you add to those massive intangible asset amortization costs we saw earlier, that heavy $1.245 billion charge. It's a structural trade-off. Now that we've inspected the twin pillars, we have to look outside the building. No structure exists in a vacuum, right? We need to evaluate the external environmental stresses currently threatening JNJ.
Section 2, Macro Hazards and Phasing Illusions. Let's dive in. This is my favorite part. This is where management usually tries to hide the bodies. It's where accounting quirks and global economic friction act like seismic activity, testing the ultimate flexibility and strength of the balance sheet. The first thing we uncovered in their Supplementary Economic Factors document is a massive, totally artificial piece of scaffolding. I call it the 53rd week illusion. Listen to this. In 2026, their financial calendar just randomly includes a 53rd week. According to their own phasing considerations, this single extra week injects an artificial 100 basis point boost to their full-year sales growth. But, and this is the kicker, it remains completely net neutral to the bottom line because of the operating expenses required to just run the company for an extra week. So when management gets on stage and brags about crossing that $100 billion revenue mark, just remember that a full percentage point of that is just calendar manipulation, not real operational momentum.
It's a temporary strut holding up the top line, for sure. You have to adjust your models for it. But the bottom line hazards are very real and entirely permanent. Let me machine gun the macroeconomic headwinds that are acting as raw friction on the company's margins right now, particularly in that med tech pillar we just discussed a minute ago.
They are currently absorbing a massive $500 million tariff hit that is exclusively related to the medtech business. No way around it. That hurts. Furthermore, they are tracking the implementation of new Section 122 tariffs at a flat 10%. On top of all of that, the elevated federal funds rate continues to maintain heavy pressure on the financing cost of their commercial paper. That is a brutal triad of external pressure. A $500 million localized stress fracture on a segment that is already lagging internationally is a serious structural risk that we have to model for.
Exactly. And this brings us right back to the restructuring costs we saw in the income statement earlier. Because let me tell you, you don't just take a $500 million tariff hit and deal with high interest rates without having to make brutal, sweeping cuts on the factory floor to protect your margins.
Market Skeptic, we zeroed in on that $276 million Q2 restructuring charge earlier, but the footnotes reveal the bigger picture. This is just one phase of a massive $1 billion restructuring program expected to be completed by Q4 2026. On top of that, they're executing a newly launched supply chain optimization program costing between $650 million and $750 million, meant to exit older manufacturing sites all the way through 2029. They are exiting markets, they are dropping products, and they are optimizing their supply chain. You really have to ask yourself, is a $1 billion overhaul just necessary routine maintenance for a 140-year-old Titan? Or is management frantically trying to shore up a sinking floor plan before the Stellara patent cliff completely caves in the roof? It's the very definition of heavy lifting. Exiting older manufacturing sites and streamlining operations is painful, expensive, gritty work. It absolutely drags down GAAP earnings in the short term, but structurally, it's designed to forge a much leaner, more resilient company for the back half of the decade. Which brings us to the final phase of our inspection today. Section 3, the verdict. Are we looking at a fortress or a trap? Okay, we have weighed the glossy top-line spin against the heavy industrial realities. The tariffs, the massive restructuring, the brutal STLR headwind. We also have to account for the sheer scale of the oncology pipeline and the forward-looking blueprints management just released to the public.
Right, and despite all those structural stress tests we just went through, management still had the absolute audacity to come out in this Q2 report and actually raise their full-year guidance. Looking closely at their press release, they state strong operational performance results in the company increasing 2026 guidance. I have heavily scrutinized management's confidence here. They are actively seeing their GAAP earnings slip, they're taking massive restructuring hits, and their biggest cash cow drug is falling off a patent cliff. Are retail investors just being lured onto a precarious ledge here, or do they actually have the concrete to back this up?
Well, let's look at the exact numbers in that updated blueprint. Because whether you like the accounting adjustments or not, the sheer monolithic scale of this operation is undeniable. The updated 2026 guidance sets an estimated reported sales midpoint of $101.1 billion. That is a 7.3% growth target at the midpoint. More importantly, they are increasing their adjusted EPS guidance by 13 cents to $11.68. Even if we strip out the 100 basis point artificial boost from the 53rd week, you are still looking at a massive structure generating over $100 billion in revenue with expanding adjusted margins.
But again, that's adjusted EPS. That's the non-GAAP fantasy land where restructuring and amortizations just don't exist. I need to see cold, hard, tangible structural stability. I don't care about adjusted accounting metrics. Show me the cash flow. Show me what is actually paying the dividends for the retail investor who is holding this stock right now.
Fair enough. Here is the ultimate load-bearing metric you are looking for, $87 billion. That is Johnson & Johnson's year-to-date free cash flow. Let that sink in. Roughly $8.7 billion in raw, unadulterated cash generated in just 6 months, up from $6.2 billion in the exact same period last year. This is the iron that pays the dividends. This is the capital that funds those massive shockwave acquisitions. This is the liquid concrete that fills the deep cracks left by the STLR patent cliff. You can argue with GAAP versus non-GAAP all day long, but you cannot argue with $8.7 billion in free cash flows sitting in the bank. Okay, I won't argue the cash flow, it is a beast, but I will leave the viewer with this final warning. $8.7 billion is massive, but so are the headwinds. You are buying into a structure that is actively undergoing a billion-dollar renovation while its main foundational pillar, STLR, is actively deteriorating. The tariffs are real, the macro friction is real, so ask yourself, are those looming patent cliffs and massive restructuring costs just too much heavy lifting for your specific portfolio right now?
And on the flip side of that coin, ask yourself if you can afford to ignore a company that can absorb all of those macro shocks, take a billion-dollar restructuring hit, and still spit out $8.7 billion in free cash flow while raising its forward guidance. That is the very essence of an ironclad dividend fortress. Ultimately, it's up to you to decide if the current valuation matches the structural integrity. Thank you for joining us for this earnings explainer on Iron Financial. Keep stress testing your investments, keep looking past the PR spin, and we will see you on the next inspection.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional.